Very good morning, friends. So I hope you're doing well, and I hope your revisions and your practice is going on very well indeed. Well, today we're going to devote a lot of time in terms of practicing questions on consolidation, and typically, of course, in this 110, where we're going to do questions on consolidate balance sheet. Of course, we'll come to questions on consolidate income statement as well. I am planning to do a comprehensive question, as I promised you, in terms of a consolidate balance sheet, which has got a lot of adjustments, in a single question itself. But I think first we're going to do some warm-up exercise for the day. So that question, of course, will come in the next class, where you're going to see a comprehensive question on a consolidated balance sheet. And we'll also do a question on the consolidated income statement as well. Now, we already know we've already made a revision in terms of the typical kind of adjustments which you confront in a balance sheet question. And we are going to follow the 7-step model which I'd given you in the previous class. So we're going to strictly read and then apply the question, apply the 7-step model in terms of getting our solution. The best part is that when you're looking in terms of the 7 steps, your focus needs to be very clear that what are the crucial focus points under each step. I just like to, remind you the focus points in certain crucial steps. Like, for example, when you look at the step number 2, you need to first of all see the type of question. Wherein you need to see that is the balance sheet, the consolidation being done on acquisition date, or is it supposed to be at a later date? If the consolidation is on the acquisition date, you can directly get the list of net assets. But if the consolidation is at a later date, then you need to divide your step number 2 in 2 parts. The step number 2A would be analysis of other equity, and the step number 2B is going to get the net assets at a fair value. And remember, when you're considering the analysis of other equity, you've got 3 focus points. One is you're going to do the analysis of other equity of the subsidiary company. You need to focus on the stock reserve, which is downstream in nature. You need to focus in terms of the fair value adjustments. Minimum of 3 focus points are there. Then I guess in terms of step number 3, you know the purchase consideration issues. Step number 4, when you calculate NCI, get the focus. Is it at PASNA or is it at fair value? Accordingly, you decide the goodwill is full or is it partial. And then the impairment of goodwill, if the goodwill is full, is borne by the NCI as well. In terms of the step number 5, that is the goodwill calculations, you need to focus on a simple format, except that you need to consider the impairment of goodwill as well. Then again, in terms of step number 6, you've got 3 focus points there as well. You need the consolidated balance sheet, other equity. So where you need to consider the parent company's own profit as a base. And then 3 adjustments. The share of parent in subsidiary post-acquisition profits, which you're going to get from step number 2A. Then you need to consider the stock reserve, which is upstream in nature. And you also need to consider the goodwill impairment. How much reduction depends upon whether goodwill is full or is it partial. So I think the main thing which you need to keep in mind is step number 2A, 3 focus points. And in terms of the step number 6, there are again 3 focus points. Then step 7 is pretty simple because you're just applying the basic 5 rules which I gave you in terms of making a consolidated balance sheet. So I think just keeping those focus points in mind, let's, I think, begin the journey. So let's, I think, first begin with a simple question. They are comprehensive questions, but not very complicated indeed. So let me just zoom the second part as well. I hope that is visible because I'll need the inputs in the other questions as well. I hope that's visible, right?
Yes, sir. Visible, sir.
Okay, perfect. So let's, I think, read question number 16. It says, hold acquired 100% ordinary shares of 100 each in sub on 1st October 17. So one thing is pretty clear, there is no NCI. Then he says on 31st March 18, the summarized balance sheet is given. So quick question at this stage. Is the consolidation on the acquisition date or is it at a later date? Of course, later date. So you are going to consider step number 2A and step number 2B, analysis of other equity and then getting the net assets. So we're given the balance sheet of the company, and then it says the retained earnings of Sub Limited showed a credit balance of 6 lakh on 1st April 17. This is the balance at the beginning, not on the date of acquisition. It says out of which a dividend of 10% is paid on 1st November 17. So the dividend is paid post the acquisition date. Hold has credited the dividend received to the retained earnings. Is this treatment correct? The parent company received the dividend and it credited the retained earnings. So is this the correct treatment done by the parent company? Okay, think about this. There is no fresh addition to other reserves in case of both companies during the current financial year. And it says there is no opening balance in retained earnings in the books of Hold Limited. Now, as far as the parent company is concerned, it had no balance at the beginning of the year. That doesn't make a difference. I have to do the analysis of equity of the subsidiary. And then he says, following are the changes in the fair value as per the respective Ind AS from the book value on 1st October. So you are given the fair value adjustments. And when you read the questions, when you read the adjustments, your mind should also start tuning that if there are fair value adjustments, which step numbers are you going to consider that? The fair value adjustments will enter the step number 2A as also the step number 7 when you make the consolidated balance sheet. Then he says the fair value of the plant and machinery is given with the depreciation rate given, the land and building appreciated, the inventories increased, and the trade payables also increase. So of adjustments, only the fair value adjustments. We're required to make the consolidated balance sheet on March 18, and the balance sheet should comply with the relevant Ind AS and Schedule 3 to the Companies Act 2013. May 2018 examination question. This was the first attempt when the new course started in. Now, there are two typical points in this particular question. I would say one is regarding the fair value adjustments and one is the dividend. I'm here to get your inputs on the fact that when the subsidiary paid a dividend and the parent credited the retained earnings, was that a correct treatment or was that incorrect in nature? I'm here to get your inputs on that. Okay, so I think let's start. In the meantime, I think everybody's still thinking on those lines.
Sir,
So
with
let me
respect,
start.
sir, with
Yes.
respect to dividend, it's declared and credited in the retained earning by the parent company. See,
Yes.
if it is a case of post-acquisition dividend and declared in the post-acquisition, then the treatment is correct.
And if it
Then
is
it
supposed to be for pre,
because this dividend no is declared out of the acquisition income of the
that
company.
becomes pre-acquisition and that should have been credited to investment. Are you indirectly saying?
Say which means that it should not be credited to the retained earning. The reason that it is it.
No, 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 no. Let me, I think, make it very clear. That is what you're speaking in terms of accounting standard 13. As per the Indian accounting standards, the dividend received by the parent company is supposed to be credited to the retained earning. There is nothing called pre, there is nothing called post. Any dividends which the parent company would receive is supposed to be, recorded in the retained earnings. So the treatment done is absolutely correct. Except that from the consolidation point of view, there is no income from the group. Because one company paid a dividend, the other company received a dividend, so it'll cancel against each other. So we need to be only eliminating this income from the group perspective. Otherwise, the treatment done in the books of the parent company standalone financials of the parent is perfect. There's nothing called pre, there's nothing called post in terms of Ind AS.
Okay, sir.
Right?
Well, the consolidation we will remove from that dividend.
Yes. Because from the consolidation point of view, it does not represent a group income because one company subsidiary paid it, the other company parent received it. So there is no group income. So we need to eliminate this income from the group perspective because there is no income. It's between the two companies. Okay, so I think let's begin the journey. So I am starting with first of all the step number one. The step number one was getting the two inputs, and that is date of acquisition and the percentage. So let's identify what is the date of acquisition and let's identify what is the percentage. The percentage is very clearly given in the question. It's 100%. There is no NCI. And as far as the date of acquisition is concerned, so I think that was 1st October 17. So the first step does not have any challenges. It is as good as just reading the question, getting the acquisition date and the percentage. Now, just for our analysis, I'm just documenting this. You need not document this part to the examiner. That what is the type of question? So type of question is we're making a consolidation at a later date. So this is only for your reference. Please do not mention this to the examiner. So I'm just looking at the type of question. And we are saying in this case, we need a consolidated balance sheet later. So I need to consider two steps in terms of 2A, analysis of other equity, step number 2A, net assets on the date of acquisition, that is step number 2B. So let's, I think, focus on the step number 2A, where we need to consider the analysis of other equity. So let's first, I think, draw the chart so we can do the analysis. So we'll make a column for particulars and one column for pre and the other for post acquisition. So let's take a column for particulars. Then we're considering the pre-acquisition profits and we're considering the post-acquisition profits, and define this in terms of dates also to the examiner, that what is pre and what is post. So we can say pre 1st October, that is the date of acquisition, and anything from 1st October till 31st March 18, that becomes post. Now, another thing which you should be very careful, that in terms of the post acquisition, this is a period of 6 months. Because my date of acquisition is 1st October 17. So from 1st October 17 till 31st March 18 is a period of 6 months. But sometimes the post acquisition period can be longer as well. And that could make a difference in terms of calculating the additional depreciation as well. Now, we're going to focus on the three focus points which I gave you. First, I'm going to look at the balance sheet of the subsidiary, do the analysis of other equity. Then I'm going to go to the additional information, look for the fair value adjustments. Then again, in the additional information, look at the stock reserve, which is upstream in nature. So one by one. So let's first of all look at the balance sheet of the subsidiary. So I guess if I look at the balance sheet of the subsidiary company, I guess we can clearly see there is other reserves and there is retained earnings. So we need to basically consider the analysis of these two figures. So one by one, we'll do the analysis. Let's begin with the other reserve. Now, we are given in the additional information the retained earnings on 1st April 17, out of which dividends are paid. And then it says there has been no fresh addition to other reserves in case of both companies during the financial year. So other reserves is given to me 20 lakhs. So once we do the analysis of this, we're going to first make a time scale and do the analysis. So let's take other reserves. Whenever you do the analysis, just take a time scale. First put in the dates so you can see very clearly what is the acquisition date, the pre-post acquisition. So my financial year begins on 1st April and ends on 31st March, and the date of acquisition is supposed to be 1st October. So we are given the status of the other reserves in the balance sheet is appearing at 20 lakhs. And when it says that there has been no fresh addition to other reserves during the year, can I comfortably say that other reserves at the beginning of the year was 20 lakhs? If there has been no additions during the year, so the balance at the end and the balance at the beginning is same, correct?
Yes, sir.
So we can say this is 20 lakhs and even this is 20 lakhs. I'm sure you can tell me how much is pre, how much is post.
Ended things are pre, sir.
Absolutely correct. Since there has been no increase during the current year, this entire 20 lakh becomes pre-acquisition in nature. So that takes care of the analysis of other reserve. Similarly, we go to the next one, that is retained earnings And again, we'll consider a time scale and then do the analysis. So this is 1st April and this is 31st March and the date of acquisition is 1st October. Let's go back to the balance sheet. So my retained earnings is given to me 1640 and I am given the retained earnings had a credit balance at the beginning of the year that is 6 lakh. But out of this, a dividend of 10% is paid. A 10% dividend on 40 lakh means a dividend of 4 lakh. First, I am given the balance at the beginning of the year is supposed to be 6 lakhs. So this balance is 6 lakh, but is this still available or you paid a dividend out of the 6 lakh? So can I say the company paid a dividend on 40 lakhs of share capital at the rate of 10%. So you paid a dividend of 4 lakh rupees. So can I say out of the 6 lakh, 4 lakh dividend is gone. So what is left over is 2 lakhs. And the balance at the end of the year is supposed to be 16 lakh 40,000. So would you like to tell me what is pre and what is post acquisition? Can I say comfortably 2 lakhs becomes pre-acquisition, right? And what about the increase of 1440? Is that post or will it be divided in the time ratio?
We got to divide into time ratio.
Absolutely correct, because my date of acquisition is in the middle of the year. So whatever is the change 1440, that's divided in the time ratio. So 7 lakh 20 becomes pre and 7 lakh 20 becomes post in nature. Now, there is one particular caution which I would like to give you at this stage, and this is typically when there is a dividend in the question. Okay, let me do that later, I think, because once I explain that part, I think it should click as well. But of course, right now I've taken the figure which is after paying dividend. But let me ask a simple question at this stage. Is this 2 lakhs the retained earnings on the date of acquisition, or is this on balance sheet date? Mind the question carefully. Is this 2 lakh rupees the retained earnings on the acquisition date, or is it on the balance sheet date?
So that is on
I have
the
taken, yes,
acquisition date, sir.
this is not on the acquisition date, because on the acquisition date, the balance was 6 lakh. You paid a dividend of 4 lakh on 1st November, which is supposed to be post the acquisition date. Let me just take you back on the data. So very clearly it says that a dividend was paid on 1st November 17, whereas the date of acquisition is 1st October 17. So can I say the balance of RE was 6 lakh on 1st October? Am I right? If I
Yes,
look at
sir.
the opening balance, it was 6 lakh, but I have taken in the outer column that is a balance of 2 lakh. So 2 lakh is not the balance on acquisition date. It is the balance on 31st March balance sheet date. I hope I'm very clear.
Yes, sir. Clear, sir.
And this is also going to create some problems later. I'll tell you why. Because when you need your net assets on the date of acquisition, step number 2B, I need the net assets on the date of acquisition. So do you think the net assets on the date of acquisition should include 2 lakhs or should it include 6 lakh?
6 lakhs, sir.
Absolutely. So once I did the calculation, and this is typically, when you're going to get dividends, you need to be very careful on the calculations. Because when I made the reduction of dividend, the idea was to get what is earned during the year. Because this 1640 is after reducing the dividends. But this figure of 6 lakh is without reducing the dividends. They're not comparable. The opening balance of 6 lakhs is without dividends. And the closing balance of 1640 is after dividends. They were not on a comparable basis. To make them comparable, what I did, I first made a reduction of the dividend and then got the change. But this writing this 2 lakh creates a problem for a later level, because when I need the net assets on the date of acquisition, I cannot consider 2 lakhs. So what we are going to do at this particular stage, we are going to, write the figure of 6 lakhs out here in the box for our reference, so that we know that this is the figure which is there on the date of acquisition and this is the figure which is there on the consolidated balance sheet. And how this is going to help me, I'll tell you later. But I am keeping this figure of 6 lakhs as a correction in my mind, that if I want the net assets on date of acquisition, 6 lakhs was there on 1st October. But if you want the net assets on the balance sheet date still available, then it is supposed to be 2 lakhs. I hope my position is very clear.
Yes, sir. Clear, sir.
And perfect. So this is, typical when there is going to be dividends. So let's continue with the analysis of other equity. One focus points is done. Now we need to go to the second focus points and consider the fair value adjustments. So here again, I'm just quickly writing the word pre-acquisition and this is post-acquisition. The second focus point is to look at the additional information and get all the fair value adjustments. So let's go back to the question and let's see the fair value adjustments. The following are the changes in the fair value compared to the book value. So I am given the fair value of the plant and machinery is 40 lakhs and the depreciation rate is 10% per annum. So land, building, inventory, trades payable, everything is given. First, let's focus on the plant and machinery. So we're going to first consider the plant and machinery. And when you consider the fair value adjustments, again, consider a time scale so that we don't go wrong. So this is on the date of acquisition, 1st April, and this is on the balance sheet date, 31st March. Now, you need to be cautious that this 40 lakhs, which is the fair value, is at the middle of the year. So what do we need to do? You need to go back to the balance sheet of the subsidiary and look at the status of the plant. Now, if I look at the property, plant, equipment, I am given the plant and machinery is appearing at 27 lakh. And I'm given the depreciation rate is 10%. Now tell me if at the end of the year, the value is 27 lakhs and there is a 10% depreciation, does this mean that 27 lakhs is 90%? And can I gross it up and get the balance at the beginning, 30 lakhs?
Yes, sir.
Absolutely.
Yes, sir.
So we know that the value at the end of the year is 27 lakhs, which represents 90%. So we can say if I gross it up by 90%, we get the value at the beginning, that is 30 lakhs. Now, we are given the status that this fair valuation was done on acquisition date, middle of the year. So what do we need to do now in this particular stage? I should now organize the book value as well as the figure at which it is revalued to get the gain or loss. So can I say the book value is going to be 30 lakhs less 10% depreciation for 6 months? Because
Yes, sir.
I have taken a depreciation 3 lakhs per annum, but if I take only for the first 6 months, it comes to 1.5. So the book value becomes 28.5 lakhs. And this is revalued at 40 lakhs. So what is the gain on revaluation? 11.5. And that is going to be, of course, pre-acquisition in nature because any fair value adjustments will always be considered pre-acquisition in nature, gain or loss. Anything else to be taken? Once you've taken this fair value change, is there anything else to be taken as well?
Yes, sir. We need to consider additional depreciation
Yes,
from
yes, sir.
that.
Absolutely correct. So the next input with reference to the fair value adjustments is considering the additional depreciation. Now, in terms of calculating the additional depreciation, we would consider that what is the depreciation which has been taken. What has been taken so far, let's compare this, and what should have been taken, let's compare this. So what is actually taken and what should have been taken so that we can get what is the additional depreciations as well. Now we've already seen what is taken is 1,50,000 after the acquisition date because the total depreciation for the year was 3 lakh. And so 1,50,000 is what is taken after the date of acquisition. But can I say if the asset is revalued at 40 lakhs, we should have taken a depreciation at the rate of 10%. 6 months, I guess that works out at 2 lakhs. So we can compare the two and we can get the additional depreciations as well. And that works out at 50,000. And this will be taken in the post-acquisition as a reduction. Right, so once you make your time scales, you will be able to get informations very clearly. So you focus on each step on a very chronological order that what is to be thought process. Okay, then I guess we're given a couple of more fair value adjustments as well. So let me just, I think, show you back on the question. So machinery with the depreciation is done. Now land and building is given, but no depreciation rates are given. So I think for land, inventory, trade payables, we'll just take the inputs directly. So land and building increase by 20 lakhs. So let's consider the land and building. So there is a fair value change of 20 lakhs out here. The next we're also given there is inventory increased by 3 lakhs. That's again pre-acquisition. Inventories also increased by 3 lakhs, and the accounts payable, the trades payable also increased by 2 lakhs. So is that a gain or is that a loss?
Loss, sir. We're going to put minus it.
Yes, it's going to be subtracted. So the fair value adjustments are done. So I think if I come back on my focus, I've taken care of the other equity in the balance sheet of the subsidiary, one. I've taken care of the fair value adjustments, two. And I guess there are no stock reserve informations given. So I think that's it. So we can now comfortably get the pre and the post acquisitions total. So let's see what is the sum total of pre and post acquisitions now. Analysis is taken care. So as you take the total, just consider 2 lakhs in the calculation. Don't consider 6. We'll take care of that 6 later. 20 plus 2 plus 7.2 and plus 11.5 plus 23 minus 2. Is it coming to 6170? 6170, I guess. And I think the other one is supposed to be 6 lakhs 70 is the post acquisition, I guess. Okay, now comes the crucial point. Once we've done the analysis, the second step B, 2B is now getting the net assets on date of acquisition, So let's do one thing. So as I organize the step number 2B, this is going to be typical in terms of a dividend question. So we need to organize the net assets at date of acquisition. So what is the net assets on date of acquisition? Can I say equity share capital plus the other equity, which is pre-acquisition in nature, correct? So let's see
Yes.
what is the share capital in the balance sheet of the subsidiary. The share capital is 40 lakhs. So this is 40 lakhs. And now the question rises, what is the pre-acquisition equity? Let me now ask you, you can vouch me. I am calculating the net assets on date of acquisition. So should I consider the figure to be 6170, or should I add the dividends instead of considering the 2 lakhs, consider 6 lakh? Because I need the net assets on date of acquisition 1st October. Is this 6170 the net assets on 1st October, or is it on 31st March, post the dividend payments?
This is a post dividend payment. We need to include that 6 lakhs.
Yes. So what I'm going to do in this particular case, this 6170, just add back the dividends out here so you get the status on date of acquisition. That's what you need to be careful when you are considering. So I would rather say you can even calculate two net assets when a dividends are given. One is the net assets on date of acquisition still available on date of acquisition. And one is the net assets which is available on the balance sheet date. So I think the better picture is, so we show two net assets in this case. So this is going to be 6570 in any case. So let's see what is the figure. This is 40 plus 6570. 105.7 lakhs. And the other net assets which we are getting, 61.7 plus 40, that's 101.7 lakh. So let me, I think, say something again so you can clearly vouch me on that part. Can I say this is the net assets which is still available, on date of acquisition, correct? 105.7 is available on date of acquisition, correct?
Yes, sir.
And can I say this is the net assets which is still available on balance sheet date, on consolidated balance sheet date, correct? So I might need both the informations, the net assets on date of acquisition and the net assets which is supposed to be, available on the balance sheet date because dividend is already paid. In other words, this is the pre-equity on the acquisition date, and this is the pre-equity still available on the balance sheet date. Okay, so my step number 2A, B is done. So I think you can notice that dividends is another point which could create a little pressures on your mind. So you need to be very careful in the analysis how you're going to tackle the dividends. That's what we've seen in this question. Okay, now with this inputs in hand, we go to the next step, and that is step number 3. So what is my step number 3?
Purchase consideration.
That's right. So we're going to get the purchase consideration, and that is nothing but the investments appearing in the balance sheet of the parent. So let's go to the balance sheet and let's see the investments in subsidiary that is appearing at 68 lakh. So we can directly consider the purchase consideration, that is 60 lakhs. 60 or 68? I missed it. The investments in the balance sheet is appearing at 68 lakhs. Then I guess we can go to the step number 4, which is the calculation of the NCI. And in this case, there is no NCI because 100% of the shares is held by the parent company. So there is no NCI. Now we go to the next crucial step, that is the goodwill calculations, which we need to be careful. So let's go to the step number 5, where we're trying to calculate a goodwill. And we know that when you calculate a goodwill, first you need to apply a simple sequence. Purchase consideration plus the NCI and the net assets, you get the goodwill. Now, let's consider first of all the purchase consideration. Step number 3, 68 lakhs. Add the NCI, which is 0 in this particular case. So that works out at 68 lakhs. And you need to compare this with the net assets at date of acquisition. Now be very careful as you answer this part. Which net assets are you going to consider? The figure which was on the date of acquisition, 105.7? Or are you going to consider 101.7? Mind you, this is the goodwill calculated on date of acquisition. So are you going to consider the net assets which is 105.7 or 101.7?
105.7.
Very
Date of
good. Absolutely. So we're going to consider 105.7, which is the date of acquisition. This is because of the dividend. And that is the reason I made 2 calculations of net asset. The other one, of course, may not be useful at this stage because there is no NCI. But don't worry, in the next one, we'll see that. So we're getting a capital reserve in this particular case, bargain purchase gain. So compare this 105.7 versus 68. 37.7 lakhs is the capital reserve, or you can say the bargain purchase gain. Wow. So this is done. Now we go to the focus in terms of the step number 6. So in terms of the step number 6, now we need to make the consolidated balance sheet, get the other equity in the consolidated balance sheet. Now again, you got 3 focus points. Of course, I'll take the parent companies as a base. Then you need to consider post-acquisition profits. You need to consider goodwill impairment, if any. You need to consider stock reserve. There is no goodwill impairment. There is no stock reserve. So we're just given the inputs as far as the post-acquisition is concerned. And of course, the dividend, which is not a group company's income. So let's go back and see what is the parent company's other equity in the balance sheet. So you've got other reserves and retained earnings. So let's take other reserves. And let's also consider the retained earnings as well, separate column. So let's take holding company's own reserve. So holding company's own reserve is 48 lakhs and 1144. This is 48 lakhs and this is 1144. So first of all, pick up the information from the holding company's balance sheet. What is the parent company's own inputs? And then we are also going to consider the share in post-acquisition. Where will you get the share in post-acquisition profits? Step number 2A.
Yes, sir. Step number 2.
That is 6,70,000 analysis of other equity.
Yes,
so
sir.
This is 70 in the retained earnings, not in the other reserves, but as part of the RE. Anything else, as I mentioned in this particular case, any further adjustments to be done? I just made a mention on that particular adjustments. Can I say the dividends? The parent company is credited the dividends as a part of 1144. But can I say this is not an income from the group point of view? So that 4 lakh dividend is a part of the RE, but from the group point of view, it's not an income. So eliminate that 4 lakhs from here, and we will be able to get the information as far as the other equity is concerned. Live simple. So this becomes 48 lakhs, and this is going to be 1144 plus 670 minus 4 lakh. I think this is 1414. Anything else to be represented as a part of this other equity? Anything else? There is something more. Anything else to be presented as a part of the other equity in the balance sheet? What about the capital reserve, which you've just calculated? Isn't that also going to be a part of the other equity? But of course, a third column. Am I right? So you're also going to consider a capital reserve, and this capital reserve which is arising is 37.7. So even that is going to be a part of the other equity as well. So this is all indirectly, you can say what we are doing. Isn't this indirectly a statement of changes in equity, more or less? Because you're basically showing the breakup of that other equity. So it's more or less, you can say, the statement of changes in equity. Okay, so I think with this inputs in hand, now we can go in for the preparation of the consolidated balance sheet as well. So let's now go back and let's go to the step number 7. We make the consolidated balance sheet. So trust me, as you go step by step, it's more easy, you're more focused in terms of what is to be done, because many vital informations you would have organized by the time you prepare the consolidated balance sheet. So please do not disturb the 7-step model. Go on the step-by-step inputs. Okay, now we need to consider the consolidated balance sheet. And as we start with the consolidated balance sheet on the asset side, we've got first of all the non-current assets. And in the non-current assets, we've got the property, plant, equipment. So as you consider the property, plant, equipment, your focus is going to be on the fair value adjustments and the additional depreciations as well. So I guess I am not going back to the balance sheet to show you the figures, but I'm just going to directly consider. So there is a land and building. Can I say land and building for the parent company is 30 lakhs. Subsidiary company is 36 lakhs. Was there a fair value increase in the land and building? Yes. I guess the land and building increased by another 20 lakhs. But there was no depreciation on this land and building. So this works out, I guess, at 86 lakhs. The next item in the balance sheet is plant and machinery. So the parent company is got a plant and machinery which is 48 lakhs. Subsidiary is got 27 lakhs, and we need the fair value adjustment. So what was the fair value increase? I think I remember 11.5 lakhs. And there was an additional depreciation, I think 50,000.
Yes, sir.
Correct. So I think this again works out to 86 lakhs. That is including fair value adjustments and additional depreciation.
Yes, sir.
There is no goodwill. The next item in the balance sheet is investments. Can I say that will not appear in the consolidated balance sheet? Gets eliminated. So that's it on the non-current assets. Now let's see the current assets. So in the current assets, we are given there is inventory. So inventory also we need to consider the fair value adjustments. And there could be another good way of making a consolidated balance sheet as well. Instead of doing all this, you can make a column holding subsidiary adjustments total. I think the next question will do that. So as far as inventory is concerned, it is 24 lakhs. Subsidy is supposed to be 7.28 lakhs. And was there any fair value changes? Yes, I guess inventory increased by another 3 lakh. So are we indirectly assuming that this inventory is not yet sold? Is that the indirect presumption that the inventory is not yet sold? Of course. If you're taking this fair value change as a part of the adjustments, it definitely indicates that the inventory is not sold. Can I ask you a quick question which is not related but indirectly related? If it was given in the question that this inventory is being sold, how would it make a difference to my solution? Because right now, when you add this increase, you're indirectly saying that this inventory is not yet sold. So if I say that the inventory is already sold, then how would it make a difference to your solution? Any inputs on that? If I say that this inventory is sold, then how would it change my answer? Of course, you will not take this fair value increase out here, but any other impacts which will happen? No problem. Then I'll also answer this in the next class. Okay, so this is inventory. The next item is given trade receivable. So trade receivable, there is no fair value adjustment. So that comes to 1196 and 8 lakh. So 11 lakh 96 and this is 8 lakh. So this works out at 19.96 lakhs. The next item is supposed to be cash and cash equivalents. And that is supposed to be 290 and 160. So this is 2.9 and 1.6. I guess this comes to 4.5 lakhs. Right, I think that's it. Nothing else is given. So we can just comfortably take the total of the asset side of the balance sheet. Is it coming to 230.74? I guess is the total of the balance sheet. So this is the total of the balance sheet. Now let's focus on the liability side, that is equity and liability. So let's consider the equity and the liability side. So first we start with the equity section and we've got equity and then there is other equity. You can give the breakup of that other equity, but I think I'll pick up the information directly. So equity share capital will be only for the parent company, that is 100 lakhs. And I guess let me just take the sum total of this. You can show the breakup as well, but I'm just taking the total of other equity put together. That's 99.84 lakhs. That is the other equity. So this comes to 99.84 lakhs. Though it is not given in this question right now, but you need to focus on another input as well, that in this equity, you need to consider NCI as well, because NCI would also be presented as a part of the equity section itself. Okay, so this is done. Then there are no long-term liabilities given. We're just given the current liabilities. And in terms of current liabilities, we are given, first of all, a bank OD. I think that is 16 lakhs. Nothing for the subsidiary. And finally, we're also given a trades payable as well. So trades payable is 9 lakh 42. So 9.42 lakhs, 3.48 lakhs. And any fair value changes in the trades payable? Yes. There's another
Yes, sir.
increase of 2 lakh. So let's see what is the trades payable. So I think 14.9. So I think that's it. This should now hopefully tally my balance sheet as well. So this is coming to, yes, I think the balance sheet is tallied.
Yes, sir.
230.74, the balance sheet is agreed. So
230.14.
230.74 lakhs. Well, so I think this question was not difficult at all, but still, what do you say? Was it difficult? I think except for the dividend point, where you need to be careful in terms of what do you need to arrange for net assets. Other than that, I think it's a pretty simple and straight question, warm-up exercise. Right, friends. So I think this is done. So let's, I think, go to the next level. We'll keep on increasing the level for the practice. Okay, so this question is done. Now let's go to the question number 17. The next question, which came in the MTP in 2021. It's almost the same question, except that there is an NCI. And once there is an NCI and there is a dividend, how does the dividend impact the NCI? That is the interesting point to be seen. So the idea of doing this question is that you get a better grip on the previous question with the add-ons. Then we'll further increase the level. Okay, let's have a look on the question number 17. It says Ram acquired 60% ordinary shares of Krishan on 1st October X1 and on 31st March X2, the balance sheet is given. So what is the type of question? Consolidation on acquisition date, or is it at a later date?
Later date it is.
Absolutely on the later date. So which means my
Later
step number
date.
2 will be divided in two parts, analysis and the net assets. Then thereafter we are given the retained earning shows a credit balance of 60,000 on 1st April X1, out of which a dividend is paid. Ram credited the dividend received to the retained earnings. So is this a correct treatment?
Yes, sir. That is a correct treatment, sir.
Yes, but from the group point of view, it's not an income, so we'll take care of that. As I said, it's absolutely similar, except that we are just having NCI. Then there is a plant and machinery, depreciation rates are given, and the following other changes are given. It may be assumed that the inventory is still unsold. I asked a question previously, and I did not get the answer, that if this inventory is sold, how does it make a difference to the solution? That question is still pending. If this inventory is sold before the balance sheet date, how would it make a difference to my solution? You still need to tell me that. And then it says, assume that the trades payable is also not yet settled. And then it says, assume the other reserves on the balance sheet date is same as at the beginning of the year. So no movements. We're required to make a consolidated balance sheet. So absolutely similar question. The idea is that we get more grip. And you're going to now help me in this particular question, because except for the NCI, everything is almost absolutely similar. The previous question might have taken us almost like 50 minutes to do, but I think this will do it in half an hour's time with your help. So let's go to the question number 17. And let's begin the inputs. So first of all, we start with the step number 1, which is organizing the date of acquisition and the percentage of holding. This time it's not 100%. So we need the date of acquisition and we need the percentage. So I guess the percentage in this particular case, if I rightly remember, was 60%. And the date of acquisition is again 1st October X1. So that information is very clearly stated in the question. This time I'm not documenting the type of the question. You already know that it is a consolidation at a later date. So I need my step number 2A and step number 2B. So let's organize the step number 2A. So tell me, what are the 3 focus points in the analysis of other equity? So what is going to be our 3 focus points when you're going to do this analysis of equity? As we decided, there are 3 focus points. So can you quickly remind me the 3 focus points in analysis of other equity?
What is pre, what is post, we have to do it.
The balance sheet of the subsidiary, other equity, focus 1. Number 2.
And we have to put the timeline to make it what
Fair
is
value adjustments. And number 3,
Stock reserve. Stock
reserve, upstream, downstream. Upstream. Okay, so let's begin particulars, and then this is pre and this is post acquisition. You need to define this in terms of dates as well. So this is going to be pre 1st October, and this is going to be 1st October till balance sheet date, that is 31st March X2. So here again, we can clearly see that the post-acquisition contains 6 months out of the current year because the date of acquisition is October X1 and the balance sheet is 31st March X2. Okay, let's first focus on the balance sheet of the subsidiary Focus 1. So I guess if I look at the balance sheet of the subsidiary, we've got other reserves and we've got retained earnings. So we need to focus on other reserves, RE. Now, as far as the other reserves is concerned, very clearly given, assume that other reserves on the balance sheet date is same on 1st April X1. So 164 was the balance of other reserves, sorry, 2 lakhs. 2 lakh was the balance of other reserve. So that remains same. So let's make a little time scale. As far as other reserves are concerned, first note down the dates. This is 1st April. This is 31st March. The balance of other reserves is 2 lakh. The balance is 2 lakh. So would you like to tell me what is pre and what is post?
2 lakhs is free.
Sir,
Absolutely.
total 2 lakhs is free acquisition.
The entire is pre-acquisition. There is no movements during the year.
Yes,
Similarly,
sir.
we can take the retained earnings as well. And again, we'll consider a time scale. So let's consider the balance on 1st April and on 31st March. So as I said, if you focus on the input step by step, there is no chance of going wrong because you know what is to be done at each stage. And that's the reason I am not doing that, technical question today. I will be coming to that question in the next class, which is going to be much, much bigger in technicalities compared to these tidbits questions. So next we are given the retained earnings at the end of the year is 164 and it says the balance on 1st April X1 is 60,000 out of which we paid a 10% dividend. So out of 60,000, 10% dividend on 4 lakh means 40,000. So we go back, this was the balance 60. This is the balance 164. So can I compare the difference or do I need to first reduce the dividends out of 60?
We have to reduce the dividend.
No. But to get the increase, you need to reduce the dividends, no? Because
Yes,
this
sir, we
is
need-
without reduction, this is after reduction, not on a comparable base.
We need to reduce 40,000 on the 60,000.
Yes, so we get the figure of 20,000. Now you can compare the difference to get the pre-post. So tell me what is pre and what is post.
1,44,000 divided by 2.
Right,
It's a
so
72,000 is
20,000
free.
balance is pre, undoubtedly. And the
Yes, sir.
increase 144 divided in the time ratio, that is 72,000.
Yeah, 72,000 free and 72,000 post.
And for our understanding, I'm just also putting in the brackets out here in a box 60 because I'll need that information because there is a dividend. So this is the only input you need to be careful on. Because of the presence of dividend, you need to be careful that net assets on acquisition date is without reducing dividends. Net assets on the balance sheet date is, of course, after reducing dividends. So this is one focus point done. Now let's go to the next focus point, continue with the analysis out here. And the next focus point is in terms of fair value adjustments. So let's go to the fair value adjustments. So we come back to the question. Let's pick up the fair value adjustments now. So I think there is no stock reserve in this case, just fair value adjustments. So fair value of the machinery again is 4 lakhs in the middle of the year and the depreciation rate is 10%. Are we going to do the same calculations?
Yes, sir.
This 270 represents 90%. So we go back, we consider the plant and machinery. Let's again make a time scale to get the data clear. So this is 1st April and this is 31st March. So can I say this is 2,70,000 at the end of the year? So can I again gross it up and say that this is 90%. So what is 100% is 3 lakhs. And the revaluation is done on 1st October. So what was the value at which it was revalued? I guess the revaluation of the plant was at 4 lakh. So let's first get the book value so that we can compare this with the revaluation. So give me what will be the book value in the middle of the year, 1st October, 6 months depreciation.
Into,
30,000 is the total depreciation for the year. So 6 months would be 15,000.
Yes, sir.
So what will be
15,000.
book value?
15,000
What will
minus
be
3 lakhs is
correct? So 2 lakh 85
yes, sir.
and the revaluation done at 4 lakh. So there is a gain of 1 lakh 15,000 that becomes pre. Anything
Yes, sir.
else to be done with reference to this?
We have to put the additional depreciation from 1st October to
Yes.
31st.
So we need to consider the additional depreciation as well. Let me just do the workings here itself. So compare with the depreciation already taken. Can I say we took a depreciation of 15,000? And we need to consider we should have taken depreciation on 4 lakhs. Can I say at the rate of 10% for 6 months? So
So it
20,000.
will, yeah, it will come 5,000 rupees additional depreciation.
Yes, 5,000 in the brackets becomes an additional depreciations as well. So this is the additional depreciation.
Is a
Next, for the
post.
fair value, yes, in the post acquisition. So this is the fair value adjustments for the machinery done, but we've got other fair value changes to be taken as well. And let's go back to the question. So in this particular case now, the other fair value changes which are defined. So we are given the following changes: land building increase by 2 lakh, inventory 30, and trades payable 20. So land building is 2 lakh. So we're given the land and building is 2 lakhs. That is increase. Then inventories also went up. Inventories was how much? 30,000. And the
Inventory.
trades payable is increase, which will be a loss in the brackets,
Yeah,
and
within
that is
bracket.
20,000. Right. I guess the stock reserve is not given. So are we done with the analysis of other equity? I think yes. Out of 3 focus points, the balance sheet, other equity done, the fair value adjustments done, stock reserve is not given. So that's done. So let's get the total of the pre and post. I don't have space, so I'll just take the pre-post total out here itself. So right now we're taking 20,000 as a base. So 2 lakh plus 20, not 60. Is it coming to 6 lakh 17,000? And I think the pre-acquisition is 67,000, I think. Practically a difference of, I think, 10. Okay, so this is done. Now comes the crucial step. So nothing different as compared to the previous question. Now the change is only because of the NCI. So I want to make it very clear how this dividends is going to impact the NCI and the other things. So let's go to step number 2B. So let's organize the data in terms of the step number 2B. So in terms of the step number 2B, I would like to calculate my net assets on date of acquisition in 2 manners. This is going to be equity share capital plus other equity, which is pre. And I want to organize this twice. One is the net assets on date of acquisition still available. Still available. Can I say on date of acquisition? And one is I need what is still available on consolidated balance sheet date. So I would say when you're given a dividends, it's a good idea that in terms of step number 2B, you organize 2 net assets. One is the net assets, which is on acquisition date, still available on acquisition date. And one is the net assets, which is available on the balance sheet date. Good to organize 2 things. So let's look at the share capital first of all. What was the share capital of the subsidiary? So if I go back to the balance sheet, so we can see the share capital of the subsidiary is supposed to be 4 lakhs. So now let's organize the data. So can I say this is going to be 4 lakhs plus, and this is going to be 4 lakhs plus. Now I want your inputs on this. Tell me what should I add? 6 lakhs 17 is after reducing the dividend of 40. So now your inputs. What do I add here when I want on the balance sheet date? 6 lakh 17 or add the dividends back? Here do we consider 6 lakh 17 or we add the dividends? Still available on balance sheet date.
So dividend we need to add, sir.
So can I say 6,17,000? And what do you add
Minus.
out here?
We have to add the dividend as well.
So we need to add back that 40,000 dividends to get the status what is available on
Yes,
acquisition
sir.
date. That is 657. Great. So let's see, this is, I think, 10,57,000. And this is supposed to be 10,17,000. So this gives me the status of the net assets. So as I said, if you're given a dividends in the question, it will be a good idea to organize the two net assets separately, because this will help us in the goodwill and will help us in the NCI calculations as well. Let's proceed. Now we go to the step number 3, and that is purchase consideration. So that we can comfortably pick up as the investment from the balance sheet. So investments is appearing in the balance sheet to the extent of, I guess, 8 lakhs. So the investment is 8 lakhs. So this works out at 8 lakhs. Then we go to the step number 4, which is on the calculation of the NCI. Is this NCI on the acquisition date or is it NCI on the balance sheet date?
Sir, we need to consider date of acquisition date, sir.
No, but I need ultimately the NCI on the acquisition date or NCI on the balance sheet date effectively. I'm doing the calculation of NCI for the balance sheet perspective. So I need the NCI effectively on the balance sheet date. So of course, we'll start with the NCI on date of acquisition. And to this, we will add the share in post-acquisition profits. Now here we need to be careful, because in this particular case, we've got two net assets with us. Now let's go step by step. Please think carefully as you answer. In this calculation of the NCI on date of acquisition, you need which NCI? 10,57,000 or 10,17,000? Think carefully before you answer.
Sir, we have to consider 6,57,000.
Are you sure? Think. This is available on balance sheet date, and this is acquisition date, this is balance sheet date. So let me, I think, give you more hints to decide. The reason of doing this question is only because of NCI, otherwise it's same with the previous one. I need the NCI to be presented in the consolidated balance sheet. So are you going to consider the net assets which is there on acquisition date or which is still available on the consolidated balance sheet date? This NCI is to be recorded in the consolidated balance sheet.
Consolidated balance sheet data.
Correct. So I'll take this 10,17,000 for this purpose. So when I'm going to consider, I will take this as the figure. I need the figure which is after dividends, because though I am saying NCI on acquisition date, but it is not the NCI on the acquisition date available on acquisition date. It is NCI on the acquisition date available still on the balance sheet date. I hope I'm clear on the focus. Correct?
Yes, sir.
So that's right. So now we need to consider the NCI indirectly at Pasna. So we take this 10,17,000 and we consider NCI is supposed to be, I think, 40%, because 60% belongs to the parent. Yes, 60% belongs to the parent. So 40% NCI, 10,17,000 into 40% is 406,800. So now you can well appreciate why are we considering two net assets. Because this net assets is useful for NCI and this net asset is useful for the goodwill calculations. And let's consider the share in post-acquisition. The share in post-acquisition profits is 67,000. So out of that 67,000, 40% belongs to the NCI. That's 26,800. So this will give us the NCI for the balance sheet perspective. 433,600, that is NCI. Great. So this is the crucial point, as far as the dividend is concerned, you need to be careful how this dividend will impact your solutions. So I think the best way is that when you do the analysis, take care of the dividends, but get two net assets at that time, so that when you do the NCI and goodwill calculations, the two net assets will help you wonderfully well. Okay, now let's go to the step number 5. So let's go to the next step. That is step number 5. So in terms of the step number 5, we now need the goodwill, for which we'll take the purchase consideration at the NCI on date of acquisition, and then we compare this with the net assets at date of acquisition. Now again, another interesting journey in terms of goodwill. So start thinking very carefully now. The purchase consideration in any case is given to me in step number 3, that is 8 lakh. Now my question to you, think carefully as you answer. This NCI on date of acquisition, are you going to consider 406,800? When you going to consider the goodwill, you need the NCI on date of acquisition. So are you going to consider this 406,800? Think carefully. I need the goodwill on date of acquisition, which is not impaired. So I need the status of the goodwill on acquisition date, which is to be presented in the balance sheet date. So your input, friends, are you going to consider this 406,800? Yes or no? I think I'll have to answer that as well. I am sure you would have done this question earlier as well. So are you going to consider 406,800? The answer is no.
It's on balance sheet date.
Calculating the goodwill on acquisition date, I need the NCI on the acquisition date still available on the acquisition date. So I'll take the new calculations based on 1057. So we're going to consider this as 1057, and this is into 40%. By mistake, also do not pick up the NCI from step number 4. So the caution is, please do not pick this figure from step number 4 when you're getting a dividends in the question. I hope you got my point very clear, friends. That when you're looking at the calculation of the NCI, you need net assets after dividends. When you look at the goodwill, you need the net assets on date of acquisition. I hope I'm clear with the agenda. Yes, silence.
Yes, sir.
Dangerous. Okay, so this is
Yes, sir.
422,800. So this is going to be a total of 1222,800. Now tell me, what is the net assets you're going to take on the date of acquisition, 1057 or 1017? So what is the net assets you're going to
1057.
pick out here? That's
Yeah,
the
we are
same.
going to 1057. We are going to take it.
Yes, I'll take the same figure because mathematical parity has to be there.
Yes,
So
sir.
you can
Good.
see that the goodwill is picking up a different net assets and the NCI is picking up a different net assets for the simple reason because of dividends. Because when you need the NCI, you need the NCI for the balance sheet point of view, which is still available on the balance sheet date, post dividends. But when you're looking at goodwill, it is computed on acquisition date, so it's going to be before dividends. You can make a note of these points to go absolutely clear. So I think this is 165,800 is the figure which we're getting goodwill, I guess.
Yes, sir.
Wonderful. So that is step number 5. Now with this inputs, we can go further, and let's now consider the step number 6, which is consolidated balance sheet, other equity, step number 6. We need consolidated balance sheet, which is other equity. So I think before we make this, I think some quick inputs to you so that you can vouch me carefully on that. Number 1, when you consider the calculation of NCI, you take the net assets after or before dividends. When you consider the NCI, do you consider net assets after or before dividend subtraction? I've just done that. I'm just asking it again.
It's on CB, consolidated balance sheet date, no, sir. So we'll take,
After.
without
And when you consider goodwill, do you take the net assets after or before dividends?
before dividend.
So just remember that when you're considering the NCI, we need the position after dividends. When you look at the goodwill, we need the net assets before dividend. So it is better in step number 2A, after step 2B, you organize the net assets before and after dividends, both to be careful calculations. Okay, so now let's go to the consolidated balance sheet. We need to organize the holding company's own equity. So I think the own equity is comprising of other equity. So that is other reserves and RE, 6 lakhs and so and so. So we've got other reserves and we've got retained earnings. Let's pick up the holding company's own other reserves and RE. So I guess the other reserves are appearing at 6 lakhs. And the retained earnings is appearing at 1,14,400. Now tell me how many focus points are there in terms of the step number 6? How many focus points to be taken?
There are three focus points: the post-acquisition profit and
That's right.
downstream unrealized profit.
Downstream and goodwill impairment. There is no goodwill
and
impairment. There is no
good.
downstream. So only one adjustments. And of course,
Yes, sir.
dividends also to be taken. Elimination.
Yes, sir.
So we consider plus the share of holding in subsidiary post-acquisition profits. Let's go back to the analysis. And in the analysis, we've got post-acquisition is 67,000. So we take 67,000 into 60% belongs to the parent. So this works out, I guess, 40,200.
Yes, sir.
And I think least we forget, we should eliminate the dividends because it's not an income from the group point of view. So I think the dividend was 40,000. 60% belongs to the parent company. So 24,000 will be reduced.
Yes, sir.
Right. So I think that takes care of this. And we have goodwill this time, no bargain purchase gain. Otherwise, we would have taken that as a part of the other equity itself. So this works out at 6 lakh. So 1,14,400 plus minus. So I think this is 130,600. So
Yes,
if
sir.
I just take the total, this is, I think, 730,600 is the other equity.
Yes, sir.
Well, now I think we're ready to go to the step number 7. So you could see the change that because of the element of dividends and the NCI presence, you should be very clear how the dividend impacts your step 2A, how the dividend impacts the step number 2B, how it impacts the goodwill, and how it impacts the NCI. That's a crucial inputs which should be clear. Okay, now we go further. Step number 7, which is making the consolidated balance sheet. Previous one. So let's consider the balance sheet and let's consider a column for the holding, subsidiary, adjustments, and total. So let's take the column for holding, subsidiary, adjustments, and total. So this will also give you a good track once you want to cross-verify your results in the exam. Okay, so let's begin with the asset side of the balance sheet. So first of all, we've got PPE. So non-current assets, we've got property, plant, equipment. So we got first of all land and building. So I think this will be now easier to put. So holding is going to be 3 lakhs and the subsidy is 360. Any fair value adjustments on the building? There was. The land and building increased by 2 lakhs, but there is no additional depreciation. So let's get the total. 8 lakh 60. Next, I am given the balance sheet. There is a plant and machinery, which is 4 lakh 80. And this is 2 lakh 70. Then we can consider the fair value adjustments. I think it was 1 lakh 15, if I rightly remember. And I think depreciation was 5,000. Is that correct? This again comes to 8 lakh 60. So this will be easy way to track the presentations as well. Very clearly given. The next investments will not appear in the balance sheet, but I think there was a goodwill. How much was the goodwill? So goodwill was 165,800 directly in the outer total column. Then next we are given now the current assets, and the current assets we've got inventory. So the inventory is appearing at 240, 72,800, and there is a fair value adjustments as well. And the fair value adjustments for inventory
30,000.
is of 30,000. So let's get the total. This is 240, 342,800. And then I'm also given the trade receivable. And that's, I think, 1,19,600 and 80,000. I don't think so. There is any fair value adjustments given. So 199,600. And then we're given the cash balance as well. No adjustments. So that is 29,000, 16,000. And the total, I think, works out at 45. I think that's it. So let's see the total of the balance sheet. So that makes a little better presentation to track also any things. So this is 860, this is 860, 165, 800, 342, 800, and this works out at 2473, 200. Right, so this I think takes care of the total of the balance sheet. Now let's, I think, go to the liabilities side as well. So let me continue with this format itself. So we make the format continued, same lines, holding, subsidiary, adjustments, and the total. So we've got holding, subsidiary, adjustments, as well as the total. So now on the liability side, we've got equity and liabilities. So let's continue first of all the equity section. Equity share capital, then there is other equity. What else to be taken apart from this? I guess NCI, that's your one item which should be tracking. So equity share capital only for the parent company, that is supposed to be 10 lakhs. So let's directly put it out here. If you want to show otherwise the workings, this is 10 lakhs. You can show the workings that subsidiary is 4 lakhs and then this is getting eliminated. So if you want, you can show that working as well. So other equity, we go to step number 6. That is 730,600. And as far as NCI goes, the NCI is to the extent of 433,600. Right. So this, I think, takes care of the equity section as well. And then we go to the liabilities. So on the liability front, I guess we are given bank OD as well as a trades payable. So bank OD. The bank OD is appearing to the extent of 1,60,000. Nothing for the subsidiary. So this appears at 160. And then there is a trades payable, which is to the extent of 94,200, 34,800. And there was a fair value increase of 20,000. So let's get the sum total of this. 94,200, 34,800, and 21,49. So I think hopefully the balance sheet should tally at this particular stage. $24,73,200 is the total of the balance sheet. Yes, the balance sheet is tallied. Wow. So I think we did this question almost 30 minutes. As I said, once you're done, then this question takes lesser time. Okay, so I think now we are very clear with the concept of dividend. The basic idea of doing this question was to give you grip in terms of dividends, because apart from the fair value adjustments, the only focus was in terms of dividends. Okay, let's go to the next one now. So let's go to the next question now. Let's look at 17, 18. Okay, maybe you want to do something different from this question, a little more higher in level. Yes, say yes. Want to do something similar or different altogether?
Different altogether, sir.
Okay, great. So we'll go to January 21 examination question. Brilliant question, which contains a very interesting part. I'll just probably crop this out. So let's first have a look at question number 19. Very good question indeed. So let's, I think, have a read on this question. Now, this question requires a little more inputs of discussions. If the need be, I'll discuss that. So this question went above the level more than the previous ones, and there is something interesting, very interesting. It says on 1st April 17, A acquired 80% share capital of S. There is an NCI. On the acquisition date, the share capital and the reserves is given to me 5 lakhs and 125 respectively. Now, my question is very simple at this stage. The examiner is giving you the share capital and the reserves on the acquisition date. Does that give me the net assets on the date of acquisition? Does that save me the trouble from doing analysis of other equity? Yes or no? He's very clearly given you the share capital and the reserves on the date of acquisition. Does that save me from the trouble of doing the analysis of other equity? Yes or no? That's the question. No inputs, and that means what? You're saying yes or you're saying a no on this case. I think I'll have to answer that as well. Well, this is, something like a bait given to you where you will say that, okay, since the net assets on date of acquisition is given, what's the good need? But I need the analysis because this share capital and reserve is without taking any fair value adjustments. That would be without taking any stock reserve, which is upstream in nature. I hope you got my point. So even if it tells you the net assets on the date of acquisition, don't get carried away with that point. Because we also need in the analysis the position of fair value adjustments, stock reserve. We also need the post acquisition. So even though he gives me the status, it doesn't make a difference to me. Then he says A Limited paid an initial cash consideration of 10 lakhs. Additionally, A issued 2 lakh equity shares with a face value of 1 at a current market value of 1.8. So the consideration is paid in cash, the consideration is paid in shares, and it was also agreed that A will pay a further sum of 5 lakhs after 3 years. What is this 3 years payment? I think we're getting agendas related to Index 103. So what does this mean? That A will pay a further 5 lakhs after 3 years. So what is this 5 lakhs?
Deferred payment.
That's right, deferred consideration. So this DC will be a part of PC at a fair value, and for this the appropriate discounting factors are given. Then he says the shares and the deferred consideration not yet been recorded by A. So where will you take these adjustments? The shares and the DC is not recorded in the financials of A Limited. So where do you plan to take this, in which step number?
PC calculations.
If you remember last time, I very clearly gave you that if there are any kind of omissions, please do one thing, make an extract balance sheet before the step number 1. So in this particular case, these omissions in terms of shares and DC will be a part of the extract balance sheet. Will not proceed with the 7-step model until and unless this is done. And let me also remind you another thing as well. Can I say in this particular case, the acquisition was on 1st April 17 and the balance sheet is on March 19. So will this omission of DC also lead to some more accounting to be done? If the parent did not record the DC, is there anything else to be done for the period of 2 years because the balance sheet is on March 19? I thought I'm going to get the answer fast like this. Remember in Index 103, I gave you a chart in terms of what is to be done on the date of acquisition and in the post-acquisition period, where I said unwinding of discount related to DDC. I hope you remember.
Yes, sir.
So can I say if there is a DC, it will result in unwinding of discount. And if there is a CC, it will lead to fair value changes because that's a financial liability or equity depending upon the forms of payment. So we need to be very careful that if there is an omission of a DC or a CC, then what are the changes to be done post-acquisition date? So we'll take that all as a part of our calculations. So I think first we'll make the extract balance sheet before we'll go further. But let's first read the question. Then the balance sheet on March 19 is given. Then he says on the date of acquisition, the fair value of the plant exceeded the book value and the remaining life is 5 years. So we'll take care of that fair value adjustments. Goodwill stands impaired. This is the first question. We were looking at the goodwill impairment, but it needs to be seen goodwill is full or goodwill is partial. Then he says the values of NCI is using a fair value. So what does this mean? That it is a full goodwill or is it a partial goodwill? NCI is taken at a fair value. Can I say undoubtedly full goodwill? Right. And if it is a full goodwill, then this impairment of goodwill will be hitting which particular steps? If there is a full goodwill, then the goodwill impairment is going to hit which steps? Can I say step number 4, 5, and 6? Am I right?
Yes, sir.
Correct. Then he says on the date of acquisition, the fair value of the NCI is already given. You are required to prepare a consolidated balance sheet. Notes to accounts not required. So this was a January 21 examination question. So I think except for the goodwill impairment, the main focus of the examiner is being on omissions. And you know the kind of question what I'm planning for the next time is got omissions, is got adjustments, is got deferred tax. But I'm getting very skeptical whether to do that question or not. Because, with these kind of questions, your answer seems to be too lukewarm. I am getting apprehensive to do those kind of questions or not. Shall I go with the gut feeling? Okay, so I think let's come back on the agenda, question number 19. So what we're going to do, first of all, let's focus first on the extract balance sheet only. So I'm just going to focus on the extract balance sheet in question number 19 before we proceed the steps. So I would say the first thing is that we should make an extract balance sheet before we proceed with the questions. Any kind of omissions should be contained as a part of the extract balance sheet before proceeding. So right now the question is not on a consolidation, it is more on the omissions part. Now let's come back on the question. We'll just concentrate on the para 1. So it says that the shares and the DC have not yet been recorded by A Limited. So let's see the entries first of all before we make the extract balance sheet. So can I say on the date of acquisition 1st April 17? Can I say the entry would have been investment account debit? And since the shares were given, the equity share capital gets a credit and any premium will be credited to the share premium account. So this is the entry which should be done on the date of acquisition. Now let's go back and see the data. So it says additionally A issued 2 lakh equity shares with a face value 1 at a market value 1.8. So tell me what will be the debit in the investment? Can I say 2 lakh shares into 1.8? That is, I guess, 3.6 lakhs. How much will go to the equity share capital? The share has got a nominal value of 1. Can I say 2 lakhs into 1? That is 2 lakhs. And can I conveniently take the balancing figure as a share premium? Correct. Now, as you put this entry, you should also get another focus point as well. Is this omission entry will lead to any accounting to be done in the next 2 years? You're given the balance sheet on March 19. So is this omission of shares, will this lead to any accounting in the next 2 years? Yes or no?
Yes.
No. This entry will not lead to any changes in the next 2 years. This entry was omitted. So this does not lead to any changes in the next 2 years. Let's go to the next one. Can I say the next entry is with regard to DC? So investment gets a debit and the deferred consideration gets a credit. Now let's go back to the DC. Can I say the deferred consideration is agreed, which is going to be payable 3 years later? So 5 lakhs will be discounted at 0.75. So this is going to be 5 lakhs is the amount to be paid 3 years later. So value that comes to 375. Will this omission entry lead to any consequential changes in the next 2 years?
Yes, sir.
Yes. And what is that?
Charging of interest.
The unwinding of discounts. So we'll do the unwinding of discount. Let's call it as UOD for the next 2 years. So one entry will be done on March 18. And can I say one entry will be done on March 19? Because you've got 2 years which have already passed by. So we need to do the unwinding of discount as well. So on 375, you take a discounting rate. What was the discounting rate? I think it was 10%. So can I say the entry will be finance charge gets a debit, the DC gets a credit, and this is going to be 10% means 37,500. Where will you take this finance charge in the extract balance sheet? Can I say a reduction from the retained earnings? Is my thought correct? This will become a reduction in terms of the retained earnings, the finance charge. Then again in the next year, you're going to put the entry finance charge gets a debit and DC gets a credit. Now tell me what will be the interest for the next year? Are you going to consider on 375 or add the finance charge and then take the interest? So this is going to be including, yes, at the finance charge, it comes to 41,250. I guess the omissions are taken care. Now let's just go back and see. Then we can make an extract balance sheet as well. So we were given the cash consideration 10 lakhs, and you can clearly see that this 10 lakhs is nothing but the amount which is already out here. So they paid a cash consideration that's in the balance sheet. A issued shares not accounted for. A had a DC not accounted for. Now, a quick question before we make an extract balance sheet. This DC was payable 3 years later, and 2 years have already elapsed. So is this DC going to be a current liability or a non-current liability in the March 19 extract balance sheet?
Current.
Current like only one.
Absolutely correct. Right. So I think let's make an extract balance sheet as well. Now we can just organize the data. Let's make the extract balance sheet. This is for the parent company. Because once you've done the entries, then I think we can simply organize the extract balance sheet as well. And the name of the parent, I guess, is A Limited. So let's see the changes. I think if I just scrutinize any changes on the asset side, investments will increase. So I guess on the non-current assets, we've got investments. The investments in the balance sheet is appearing at 1,000. The figures are in thousands. So how much are you going to add in the investment? 3.6 and 5 lakhs in terms of thousands will be what? 360 as well as, so this is going to be 360. And then the next one, what we add, this is going to be 375. So this is the omission of the shares and DC. This comes to, I think, 1735. So now when you go to consider your step number 4, Sorry, step number 3, purchase consideration. You go pick up the PC from the extract balance sheet. That makes life simple. Okay, so investment is done. Let me just correlate. So this is done. This is done. I guess nothing else on the asset side. Now let's go to the equity section. So now let's go to the equity and liability section. So can I say in the equity section, equity share capital will change, RE will change. The equity share capital of the parent company is appearing at 2000. And to this 2000, you're supposed to add this share capital, which is 2 lakhs in terms of thousands will be 200. So that works out at 2200. Then I guess I am given the retained earnings and I also need to add the share premium. This will be a part of the other equity. So let's go back and include these inputs in the extract balance sheet. So share premium would appear at 160. So share premium becomes 160. The retained earnings already given is 1400, and from this 1400, you need to make the adjustments on finance charge. So take care of this finance charge from the RE. That's, I think, 37.5, 41.25. 37.5, 41.25. So 1400 minus 37.5 minus 41.25. This, I think, 1321.25. So the finance charge stands adjusted from the RE. Let's see what more is left over in the entry. So I think this entry is done. Then there is, I think, only DC left over. So let's take all the amounts in the DC, and that would be appearing as a current liability in the balance sheet. So DC is going to be 375, 37.5, 41.25. So DC is 453. DC is 453.75. So this is going to be shown as a part of the current liabilities, that is DC. Wow. So I think I've taken care of the omissions as a part of the extract balance sheet, the omission of the investments done, the omissions of the share capital and the premiums done, unwinding taken care, all the entries are done. Now this becomes a question where we can proceed further. So now we need to do all the 7 steps with you. But I think before that, we should take a break. Wasn't this a good question? I have seen one thing, over a period of time, the question levels is getting better. So from May 2018 onwards, what we stand today in 25, the level of the question is continuously on the rise. I hope, friends, you got the concept of the extract balance sheet in terms of the emissions, I guess. Perfectly clear?
Yes, sir.
Wonderful. So I think let's take a quick break now, and then we can start off with the 7 steps back in this particular question. Goodwill impairment is there. I think other than that, nothing too technical. So relax your minds. We'll continue 10, 12 minutes. Back with you. Mind. So what we were doing was the concept of an extract balance sheet, and now we need to apply the 7-step model in this particular case. So let's begin the journey. So once we're done with the extract balance sheet, we come on to the regular steps. So my step number 1, as usual, is going to be focusing on the date of acquisition and the percentage. So let's see what is the date of acquisition and what is the percentage. So I guess as far as the date of acquisition is concerned, it's 1st April 17. And as far as the percentage is concerned, it is clearly given, it's 80% in the question. Okay, then I think we can focus in terms of the step number 2A, that is getting the analysis of other equity. So as usual, we know that there are a total of 3 focus points. Just to remind you, the balance sheet of the subsidiary, other equity, the stock reserve, which is upstream, and the fair value adjustments. So let's draft this 3 columns, particulars, pre and post. But now we need to be careful because the pre-acquisition and the post-acquisition, typically the post-acquisition has got more than a year because the balance sheet date is on March 19. So it's a 2 years, which is a post-acquisition. So this is going to be pre-1st April 17, and anything from 1st April 17 till March 19, that is a period of 2 years, is post-acquisition. So let's first of all go back to the balance sheet, have a look at the other equity in the balance sheet of the company. So I guess we are given a retained earnings that's to the extent of 300. And we are also given the status. It says the share capital and reserves was 5 lakh and 125 respectively. So the reserves was 125 on the acquisition date, and at the end of the year, it's 300. So let's make a time scale. So we're going to consider the retained earnings, and let's consider a time scale. So this is April 17 and this is March 19. So this is 300 and this is 125. So would you like to tell me what is pre and what is post acquisition in this case? Comfortably 125 pre, and can I say the increase is post, correct?
Yes, sir.
Correct. So I think the first focus point is done. Now we are not given any stock reserve, but I think there was a fair value adjustments, I guess. So we are given in point number 1, on the date of acquisition, the fair value of S exceeded the book value by 2 lakh. Can I say this in itself is supposed to be the fair value adjustments, and the remaining life is supposed to be a period of 5 years. So let's consider the fair value adjustments in terms of plant. So can I say 2 lakhs is supposed to be, so we'll take the figures in thousands. So this is 200. And tell me what will be the additional depreciation because of this fair value adjustments? The life is 5 years. So what will be the additional depreciation for the post-acquisition period?
80,000.
Wonderful indeed. So 200 divided by the remaining life 5, it makes it 40. We need a depreciation for 2 years because post-acquisition is 2 years. So this is going to be 80. So basically 40 is the depreciation for a period of 2 years. That's the focus point, that the post-acquisition is a period of 2 years. I think that's it. Nothing else is given. So we can comfortably get the pre and the post-acquisition status. This is, I think, 325, and I think this is 95. Right, so I think this takes care of the step number 2A, and now we can go on to the step number 2B. So no dividends, nothing. So I think the life is simple. We don't need to bother in terms of calculating any 2 net assets as we've done in the previous 2 questions. Just get directly the net assets on date of acquisition. So can I say that will be a sum total of the equity share capital plus other equity, which is pre-acquisition? So in terms of equity share capital, see the balance sheet of the subsidiary. Don't look at the extract balance sheet. The extract balance sheet is for the parent company, not for the subsidiary. The tendency at times is one, tends to look at the extract balance sheet. But this is the extract balance sheet only for the parent, not for the subsidiary. So the share capital is 500 and the pre-acquisition equity is 325. So I think that works out at 825. That is net assets on date of acquisition. Great. So I think now we are comfortable to go to the next steps as well. So let's go to the step number 3. What is the step number 3? Purchase consideration. Now you can tell me, where are you going to pick up the purchase consideration? Because we made an extract balance sheet and the investment stance changed. So am I supposed to pick up the PC from this extract balance sheet? Yes, of course. So let's see what is the investment in the extract balance sheet. It is 1735. So that is picked up from the extract balance sheet. Then we go to the step number 4, which is the calculation of the NCI. We need the NCI on date of acquisition. And to this we add the share in post-acquisition profits. We add the share in post-acquisition profits. So what is the NCI? Is it at fair value or is it at PASNA? I guess it is at a fair value as per the instructions. It says in point 3, the value of NCI is using a fair value method and the value is 3,80,000, so 380. This is given at a fair value, which means your goodwill is supposed to be full. And if the goodwill is supposed to be full, there is a goodwill impairment as well. So let's first consider the share in post-acquisition. So can I say that's 95? And what is the share of the NCI? 20%, I think. That makes it 19. Anything else to be taken care as well? Any further adjustments to be done in terms of NCI? I just said something. Your NCI is at a fair value. There is a goodwill impairment. So any further adjustments to be taken in NCI?
Sir, will impair the goodwill and the share of NCI will be like
Correct.
deducted from.
Yeah,
That's right. So we've given the goodwill impaired by 258. So we'll also reduce the share of the NCI in goodwill impairment. So we'll take 258 into 20%. Because goodwill is supposed to be full, NCI will also bear the share in the impairment loss. So that works out at 51.6. So this will give us the NCI. 347.4. Okay, then we go to the step number 5. And in terms of the step number 5, we need the goodwill. And we again consider the purchase consideration, add the NCI, and compare it with the net assets. And lest we forget, we also need to reduce the goodwill impairment. And then we'll get the final goodwill for the consolidated balance sheet as well. So all the data is available clearly. The purchase consideration is 1735. Can I comfortably take this NCI from step number 4? Can I say the only situation where you cannot take the NCI from the step number 4 is when you're given dividends in the case. But can I say if the dividends are not given, then you're comfortably, you can pick up the NCI. So that is 380 on the acquisition date. So that makes it 1735 plus 380. That's 2115. And let's get the net assets from step 2B. That's 825. So this works out at 1290. And how much goodwill impairment are you going to reduce? The entire goodwill or the parent share?
We have to reduce the entire goodwill, sir. 2,58,000.
Correct. That's right. So the entire goodwill was, I think, 258. Because goodwill, we need the revised figure. So the share is not important at this stage. This is 1032 is the goodwill. Okay, so step number 5 is done. Now we need to go to the step number 6, which is organizing the other equity in the consolidated balance sheet. So let's go to the step number 6. So in terms of step 6, we need the consolidated balance sheet, other equity. So we'll take the parent company's RE. Where are you going to take the RE of the parent company? Which information are you going to pick it up? Balance sheet or something else? Extract balance sheet again. We need to keep the focus clear that we made the extract balance sheet. So now whatever information you need to pick it from the extract balance sheet. So let's get the information from the extract balance sheet. I think there were two figures. One is RE and one is share premium. So pick this. This is holding company's own profits, which we are picking from the extract balance sheet. So it's very important that when you pick the PC in step 3 and when you pick the other equity, you need to show that if you made an extract balance sheet, pick up all the figures from the extract balance sheet itself. So let's see what is the figures in the extract balance sheet. So the equity share capital, the RE is supposed to be 1321.25. 1321. So this is 1321.25 and the premium is 160. Okay, now the focus points again 3. Dividend is not there. So we've got 3 focus points. Share in post acquisition. There is a goodwill impairment, but there is no stock reserve. So we consider the share of holding in subsidiary post acquisition. What was the post acquisition profits? I think 95 into 80% belongs to the parent. Then there is goodwill impairment. So are we reducing the full goodwill impairment or only the parent share?
Only parent share, sir.
Correct. So that was, I think, 258 was the goodwill into 80%.
2,06,400.
Okay, so in terms of thousands, it will be 206.4. And this is 76. So I think that's it. Nothing else is given. So we can get the total. This is 160. 1321.25. 76, 206.4. This is 1603.65. Okay, so the step number 5 is also done. 6 is also done. Now, finally, we need to make a consolidated balance sheet where again your extract balance sheet will come into the play because holding company, a lot of information is in the extract balance sheet. So we're going to follow the same technique. In step number 7, make some columns. In terms of step number 7, consolidated balance sheet. So here again, let's take columns for the parent, subsidiary, adjustments, and the total. Holding, subsidiary, adjustments, as well as the total. So let's begin with the asset side of the balance sheet. Non-current assets, PPE. So for the parent company, it is given to me 5,500. Subsidiary is 1,500. There was a fair value adjustments, I guess that was 200, I think. And additional depreciation was, I guess, 80. I hope this is correct, right?
Yes, sir.
Great. So that works out at 7,000 plus another 120, 7,120. The next investments will not appear in the balance sheet. Then we've got current assets, but before we forget goodwill. So let's see the goodwill. So goodwill is 1032. And then we've got the current assets. The current assets we are given inventory. There are no changes, no adjustments in the inventory. So there is, I think, 550 and 100. That makes it a total of 650. Then next we are given receivables. The receivables is to the extent of 400 and 200. And there is no intercompany owing nothing. That makes it 600. Then there is cash. And the cash is to the extent of 250. There is no adjustments. That makes it 250. So this will take care of the asset side of the balance sheet. I guess 9652 is the total of the balance sheet, I think. Then on the liability side, we are given the share capital. So let's consider equity. So we've got equity share capital and the other equity. So equity share capital only for the parent, that's 2000. If you want, you can show the adjustments elimination of 500. So that makes it 2000. And let's see what was the other equity. Let me just take the sum total of this. 1603.65. This is 1763.65. 1763.65. Anything else to be taken as a part of equity, which we might tend to forget? NCI. So as far as the NCI is concerned, this is appearing at 347.4. 347.4. Okay, and I think then we're given the non-current liabilities. So non-current liabilities are appearing at 3,400. No adjustments. That makes it 3,400. And current liabilities, I'll merge the DC. So current liabilities is supposed to be 1250, 650. And what was my DC? Extract balance sheet. Investment done, share capital already done, 453.75. 453.75 is the DC. So let's see what is the total of the current liability. 1250, 650, 453, 2353.75. Let's see whether the balance sheet is agreed on this. $1763.65, 347.4, 2353.75, and 2000. I think there's some difference which is coming, right? Is the calculations correct? Let me just see. Equity share capital, that is appearing to the extent of, let's go back to the exact balance sheet. Did I take the correct equity share capital? It's 2200, my mistake. Equity share capital is 2200. This was 2200. So this was 2200. Extract balance sheet, this is 2200. I guess rest as far as the current liabilities are concerned, correct. Non-current is correct. NCI is correct. And seems to be some discrepancy on the step number 6. We'll just quickly have a look at step 6 if this is correct. 1321. Oh, I added it up. My calculation error. This is 1090. This is 1090.85. So this is to be rectified. So 1090.85 plus 160, this is 1250.85. This is 1250.85. I think now the balance sheet should tally 2200, 1250.85. Then this is 347, right? 347.4, 3400, 2353.75. So we're still getting a difference of 100, is it? 2200, 1250.85, 347.4, 2353, 9552. I'm still getting a difference of 100, I think. Is the step number 6, just see, is the calculation error. Just see if this is correct. Oh, my mistake error on the calculations again. This is 1190. I'm afraid. This is 1350. Totaling error. So this is 1350. Now the balance sheet is agreed. This is 1350. The balance sheet is tallied at 9652. Totaling error. Right, friends. So this question is also done. I would not say it was a very tough question, but I think it was good because this has got extract balance sheets in them. Otherwise, I think it's pretty simple indeed. Okay, so this is on the consolidated balance sheet. Now, we've got another area in the consolidated balance sheet, and that is the concept of what is called a chain holding. But I'm just thinking that should I do chain holding at this stage? Yes, maybe. Or consolidate P&L revision? What do you say? Chain holding or consolidate P&L revision? Your choice. I think we can do chain holding. What do you say? The silence means a deemed acceptance.
Yes.
So I think let's go to the chain holding now. We've done questions on normal consolidation. Let's look at now a question on a consolidation, which is on a chain holding. So 2 questions have so far come in the exams on the concept of chain holding. Let's see the question number 20, which is an examination question. Let me zoom this out. I think I can use the space. I don't need 21 at the moment. Right. I think let's have a look at question number 20. So a few more technical adjustments which you'll confront in a chain holding. It says in question 20, prepare a consolidated balance sheet on March 2018 for a group of companies comprising Usha, Nisha as well as Sandhya. And after the balance sheet is given, though I think you might have noticed, it was a very old question, so I think it's not exactly as per the format of Indies. The equity side started earlier, but don't worry, we'll make it correct in the solution. And then it says the following additional information is available. Usha's got 80% shares in Nisha, and Nisha has got 75% shares in Sandhya, and the holdings were acquired on 30th September 17. The business activities of all the companies are not seasonal in nature, and therefore you can comfortably assume that the profits are earned evenly throughout the year. I think it goes without saying, even if the question is silent, that's a presumption. Then he says on 1st April, the following balances stood in the books of Nisha and Sandhya. So these are the balances of reserve and retained earnings at the beginning of the year, which is not acquisition date. Acquisition is in the middle of the year. Then he says 5 lakh included in inventory of Nisha is inventory which is purchased from Sandhya. So there is a company Usha, Nisha, Sandhya. Now I am given that inventory of Nisha includes something which is sold by Sandhya, which has been purchased from Sandhya. So is this upstream or is this downstream? Nisha purchased from Sandhya. Sandhya is like the bottommost company and it is selling to Nisha upstream, downstream. I gave you the inputs as well. Sandhya sold to Nisha. Already given you the answer. It is undoubtedly upstream in nature. Then he says the parent company adopted an accounting policy to measure the NCI at a fair value, which is, as per 103, assume the market price of Nisha and Sandhya same as the respective face value. So we're assuming that the face value and the market price is same. Then in point number 4, 6, you can ignore. This is not really a correct sentence. And analysis of profits must be a part of your answer. That's it. So this was November 18. Chain holding came for the first time in the exams in November 18. Okay, so I think there is no adjustments except for a stock reserve upstream in nature. No goodwill impairments, no fair value adjustments, nothing. So I think we're very safe. Now, the only cautions to be taken during the course of chain holding is that there will be now double information. Two analysis, two net assets, two NCI, two goodwills, everything becomes double because there are two subsidies. But first we need to organize the data in terms of the acquisition dates. So let me just delete this part. So let's begin with the question number 20, is it? Yes, 20. So let's organize the data. Question number 20, we'll go step by step. So we've got the step number 1, organize all the dates of acquisition and the percentages in this case. Now, we are given the status of the company. Usha is got in Nisha and Nisha is got in Sandhya. So let's organize the data. Usha has got shares in Nisha and Nisha has got shares in Sandhya. So we need to carefully organize the data. So let's see the percentages and the date of acquisitions in this case. So I guess we are given that Usha has got 80% shares in Nisha and Nisha has got 75% shares in Sandhya. And the date of acquisition in both the cases is 30th September 17. This is also 30th September 17. So this is the status which is given. Now, the only new addition what you need to do in terms of chain holding is consolidation will be done from the point of view of the top company, which is Usha. And if you're doing the consolidation from the point of view of the top company, we need what is the effective stake of Usha in Sandhya. So one thing which you're going to organize in this case is look at the effective share Usha is got in Sandhya. So can you tell me what is the effective stake which Usha is got in terms of Sandhya? Considering that he's got 80% and then 75. So can I say 80% of 75? Is that correct?
60%.
That becomes 60%. So can I say the NCI is effectively what? 40%. So this is one thing which you need to organize in terms of chain holding in the very first step, because when you're organizing the chain holding, the consolidation will always be done from the top company's point of view. So you need to see that what is the percentage stake. So when you need to see what is the percentage stake, you need to see what is the share of the top company in the bottommost company. Okay, so this is in terms of step 1. Then we can go further and have a look at the step number 2A. So let's have a look at step number 2A. So in terms of the step number 2A, we need analysis of other equity. Now you need two analysis. So let's organize the data for two analysis now. So one is for the middle and one is for the bottom company. So let's consider the analysis pre and post. And let's consider the analysis pre and post. So we'll consider one is Nisha and one is Sandhya. So we have got two subsidies effectively. So we're going to do the analysis of both the subsidiaries on a separate basis. So let's now consider this as pre and this as post, and this is pre and this is post. Okay, so we've got pre and post in terms of Nisha as well as Sandhya. So let's define the dates. This is pre 30th September. And this is going to be 1st October till 31st March. Only 6 months in the post acquisition. And this is also pre 30th September. And this is 1st October till 31st March. Okay, now in this particular case, there are no fair value adjustments given. And I'm given a stock reserve, that's it. So my focus point is the balance sheet of the subsidiaries and the stock reserve, that's it. So let's organize first of all Nisha. So I'll not show the balance sheet to you. I'm just going to pick up the information. So I am given first of all Nisha, I'm looking at reserves. So I'm looking at the reserves of Nisha. So the reserves of Nisha at the beginning of the year is supposed to be 40. And the reserves in the balance sheet is appearing to the extent of 50. And the date of acquisition is middle. So would you like to tell me what is pre and what is post? This is middle of the year is the acquisition date. This is 1st April, this is 30th September, and this is 31st March. So tell me what is pre and what is post.
Sir, 40,000 is free.
Absolutely. And what about the increase of 10 time ratio?
Yeah, 10 for the 5,000 is free, 5,000 is post.
Correct. And we will take a separate column in the post acquisition reserve because we like to add the reserve to reserve and we like to add the retained earnings to retained earnings. So it is better to create a sub columns in the post acquisition. Not required for the pre acquisition, but you should do it in the post so that later I can add reserve to reserve and I can add RE to RE. Okay, so the reserves is done. And then moving forward, we are given retained earnings. Let's again make a time scale. So we're given the balance on 1st April, the balance on 31st March, and the date of acquisition is 30th September again. So in terms of RE, I am given the balance at the beginning is 10 and the balance at the end is 25. So I think we can do a similar kind of analysis. Can I say 10 is pre? And the increase of 15 divided in the time ratio?
Sir, 7.5 is free, post.
Yes, and that I've taken into a separate column altogether. Anything else to be taken care in Nisha? I think the sale was made by Sandhya to Nisha. So I think that stock reserve will come in the Sandhya's analysis, not in Nisha analysis. So that's it. Nisha has got no more data. You can comfortably close Nisha, get the pre and the post acquisition. No fair value adjustments, no stock reserves, nothing. So I think this is 5. This is 7.5. This is, I think, 62.5. Okay, so this is done. And then we go on to the next company, Sandhya. Let's begin with the reserves. And again, consider a time scale. So except that it's a chain holding, so we've got two analyses, but the technique of doing the analysis, everything remains exactly same. So my date of acquisition is the middle of the year, that is 30th September. My reserves on the beginning of the year is 30 and the reserves in the balance sheet at the end is 40. So I think you can comfortably again decide what is pre and what is post. So 30 is pre and the increase in the time ratio, create a separate column, yes, for reserves and RE. And we do a similar inputs in terms of retained earnings. Take a time scale again. 1st April, 31st March, and this is 30th September. So here again, we've got the retained earnings is 15. At the end of the year is 30. So we can again do the same thing. 15 is pre. The remaining is divided in the time ratio 7.5. Correct.
Yes, sir.
But there is another thing which is to be taken at this stage, which is the stock reserve upstream in nature. Because if it is upstream, we need to eliminate this from the analysis. So let's go back to the additional information and let's look at the stock reserve information. So coming back to the point number 4, 5 lakhs is included in the inventory of Nisha, which is purchased at cost plus 25%. So cost plus 25%, can I say, is 1/4 on cost, and can I say is 1/5 on sale? So on 5 lakh rupees, 1/5 would mean, can I say, comes to 1 lakh is the profit. So we need to eliminate this 1 lakh unrealized profits from the post acquisition column, right?
Yes, sir.
So
Post
this will be
acquisition.
eliminated from RE. That's it. No fair value adjustments are given. So step number 2A is done. So let's see the total of this. So there's no complication. Absolutely same. This is 5, 6.5. And I think this is 57.5. Okay, so step number 2A is done. We've done 2 analysis because there are 2 subsidiaries in this case. Now we need step number 2B, which is the net assets for both the companies again. So let's go to the step number 2B, and we need to organize the net assets on date of acquisition. And this is again going to be organized for Nisha as well as Sandhya. So we organize this for Nisha as well as for Sandhya. So we've got equity share capital as well as other equity, which is pre-acquisition. And we get the status of the net assets on date of acquisition. Okay, so let's, I think, consider the equity share capital from the balance sheet of the company. Nisha, I guess, is 200 and Sandhya is 160. And other equity pre from the analysis, 62.5 and 57.5. This is 62.5 and this is 57.5. So that works out, I think, 262.5. And this will be 217.5. Wow. I think step number 2A and B is done. Now becomes the crucial part of the question. Of course, step 3 is not a big problem, but step 3 needs some considerations as well. So let's go to the step number 3. So in terms of step 3, we need the purchase consideration. So we've got shares which Usha has in Nisha. And we've got the shares which Nisha has in Sandhya. So first, let's note down the investment from the balance sheet of the question. So investments is appearing at 170 Usha in Nisha, and it is 140 Nisha in Sandhya. But we are consolidating from the point of view of Nisha. So will I take this investment or should I consider from the point of view of Usha, which means I take 80% of this because this is the investment middle in bottom, but I need top and bottom effectively. So should I take this as it is or we take 80%? I need the share effectively Usha in Sandhya. So we need to consider 80% because we need to consider the consolidation from the top company point of view. So 80% would mean 112. And can I say, let's get the balancing figure. So this is going to be 28. So we need to split this investment in step number 3 in terms of chain holding. Now, a very interesting question which comes to the mind, which you need to answer at this particular stage. So let me ask you that particular question. When you go to calculate the goodwill, you're going to consider the investment at 140 or 128. Sorry, 112. So when you go to consider the calculations of the goodwill, are you going to consider 140 or 112? That's my question. So when you go to consider your calculation of the goodwill, are you going to consider the investment at 140 or 112? You're consolidating from Usha's point of view. I think I'll have to answer that question as well. 112. Then the question rises, where do you take the 28? What do you do with this 28, which is the remaining 20%, which is funded by the NCI? Okay, I think I'll have to answer that as well. Okay, I think let's go ahead. Shareholding makes the scene different. So let's go to the step number 4. So let's go to the step number 4, which is calculation of the NCI. And let's also look at the step number 5, which is the calculation of goodwill. So we'll just organize the data, because now these two calculations should be technically done simultaneously. Not exactly, but since you're going to take 80% investment in goodwill, the remaining 20% is to be adjusted in the NCI. So let's organize the data first. So in terms of NCI, we've got 2 companies with the NCI. In terms of goodwill also, we've got 2 companies for goodwill. So we've got Nisha and we've got Sandhya. We've got Nisha and we've got Sandhya. So let's first organize the data. We'll just first put in the things, then we'll just fit in the numbers as well. So in terms of NCI, we need the NCI on the date of acquisition. So then we need to add the share in post-acquisition. We need to add the share in post-acquisition. And then there will be some adjustments done, which will take care. Then in terms of goodwill, we've got the purchase consideration at the NCI on date of acquisition. And then compare it with the net assets on date of acquisition. And we will be able to get the goodwill in this case. Okay, now with this inputs, I think let's organize the information for the companies. Let's go step by step. First of all, I am given the status of NCI in the additional information. So let's take you back on the question. So I am given the status of NCI in point number 5. The parent adopted the policy to measure the NCI at a fair value and assume that the market price of Nisha and Sandhya is same as the face value. So let's, I think, ask you that. Can I comfortably take this as the market value of the shares, considering the face value and the fair value is same? Is that correct? Can I comfortably take the face value and the fair value same as per the instructions in the question? Correct? Undoubtedly, yes. So let's go back 200 and 160. So can I say this is going to be 200? What was the stake of the NCI? Percentage stake, I think Usha in Nisha was 80. So 20% belongs to NCI. And I think in terms of Sandhya, did we calculate the effective NCI to be 40%? Am I right?
Yes, sir.
Great. So this is 40 and this is 64. This is the NCI at a fair value. The share capital at the face value and the market value is same. So we're taking the NCI share in that. Now let's consider the post-acquisition share. So in terms of the post-acquisition share, we come back to step number 2A. So can I say the share in 5 and 7.5, the share in 5 and 6.5? So we need to consider the share in 5 and 7.5, 20%. We need to consider the share in 5 and 6.5, 40%. The share in the post-acquisition reserves as well as RE. This is, I think, 2.5. This is, I think, 4.6. So this comes to 42.5 and this works out at 68.6. Okay, let's now leave the NCI and go back to the calculations on goodwill. So in terms of goodwill, let's see what was the PC in step number 3. The purchase consideration 170 and 112. This is 170 and this is 112 from Usha's point of view. So the question still remains, what about that 28 which is not taken here? Can you tell me what do I do with the 28? Because you're taking only that 80% financed by Nisha, which means the remaining 20% is financed by outsiders NCI. So what do you do with that 20% not in the goodwill calculations? And the regular classes, of course, I've given the detailed explanations as well that why the treatment happens, but what am I supposed to do? Can anybody tell me what do I do with the 28? Okay, I think I'll have to answer that part as well. Oh my God, I'm getting more apprehensive of doing a comprehensive question in the next class. You're scaring me. Do you think we're ready to do a complicated question over and above this kind of a question? The silence seems to be a no. Then let's change the mind. This is 28. Otherwise, I'll end up doing the question in the next class on my own. Okay, so this 28 gets reduced from Nisha. Can anybody tell me why did I reduce it from NCI? Why did the 20% get reduced from the NCI? Why did I reduce it from here? Okay, no answers on that. I have explained the detailed logics in the regular classes. You want to look at the logic, please look at that once again. But in short, I'll just tell you that in this particular case, 80% is financed by Nisha, by Usha, and the remaining 20% is financed by the NCI. So in this particular case, if you try to make a consolidated balance sheet, considering the 80% of 75%, naturally that remaining 20% remains in the balance sheet on the asset side. So it has to be netted off against NCI to eliminate that. I've given a detailed logic of that in the regular sessions as well. So this works out at 14.5. And this remains at 68.6. Let's take the total of this. That's 83.1 is the total NCI. Okay, then I guess let's come back on the goodwill. So NCI on the date of acquisition can comfortably be taken from this place. This is 40 and 64. So this comes to 210. And this is 176. Let's take the net assets on the date of acquisition from the step number 2B. That is 262.5. And this is, I think, 217.5. Correct. So I think in both the cases, we are getting a capital reserve, not a goodwill. So we get a capital reserve. This is 52.5. And this is 41.5. So we can add this as well. The capital reserve in total is 94. Okay, so step 4 and 5 is done, NCI goodwill. So the only thing which you need to be cautious in terms of chain holding is that when you consider the investments in step number 3, remember to split the investment. One portion goes in the goodwill calculation, other portion goes as a reduction of the NCI. So that is a new addition which comes in a chain holding question. Okay,
So-
now yes.
Sir, what about that in NCI that upstream sale on unrealized profit?
That we've already taken in the analysis.
Okay, sir.
Yeah. So now we come to the step number 6. So let's go to the step number 6. So now we need to do the exercise for both the subsidiaries company in terms of step 6, the consolidated balance sheet, other equity. So we need, first of all, the holding company's own profits. I think there are two inputs in other equity, reserves and retained earnings. So we've got reserves and we've got retained earnings. So we'll first pick up the holding company's owned reserves and retained earnings and then make the adjustments. So in this particular case, I guess out of the 3 adjustments, post acquisition is there. Stock reserve was upstream, that's been taken care. No goodwill impairments. There is a capital reserve rather. So the parent company has got reserves of 90 and retained earnings 80. So let's consider the share of holding in subsidiary post acquisition. So we need 2 shares. We need 2 shares very carefully. We need the share which is Usha in Nisha. And we need the share which is practically Usha in Sandhya. So we need the top company share in the middle and in the bottom company. So effectively not Nisha and Sandhya, but Usha in Sandhya. So let's go back to the analysis of other equity. So this is 5 and 7.5 and this is 5 and 6.5. So we'll add it to the respective columns. So can I say this will be 5 and this is going to be 5. This is 7.5, 6.5. I think this was 80% and I think this was 60%, right? Usha and Sandhya effectively, I think 60%. So we're taking the respective inputs. This is Usha and Nisha and this is Usha and Sandhya, respective figures. So this comes to 4. This is 3. This is 6. And this is 3.9. I think that's it. Nothing else is given. So we get the sum total of the other equity as well. So this is, I think, 97. And this is, I think, 89.9. And I guess least we forget, we can just add another column as well. There was a capital reserve. So I think, let's see, what was the capital reserve? I think it was 94. So we can just add up the other equity as a total as well. So 97, 94, 89.9. I think the sum total of this is 280.9. Right, so step number 6 is taken care. Now we are in a comfortable position to make a consolidated balance sheet, which we are going to make in a columnar form to get the results. Okay, so I think let's begin with the calculations of the step number 7. So we've got step number 7, which is the consolidated balance sheet. So this time we've got 3 companies. So particulars, then we've got Usha, Nisha, Sandhya, adjustments and the total. So let's take Usha, then the middle company Nisha, then the company Sandhya, then the adjustments, and then we get the total. Okay, so they are practically all subsidies, so you need to consolidate all the subsidies in this case. So let's begin with the balance sheet information. So we're going to, of course, make the balance sheet starting with the asset side. So we've got non-current assets. And I think the first one is tangible assets. So in terms of the tangible assets, this is Usha is 160, then this is 180, and this is 150. No fair value adjustments, just add them. 490.
490.
Investments will not appear in the balance sheet. Then we given there was capital reserve that is done. So let's go to the current assets. Current assets, we are given the cash in hand and bank. And that's, I think, 114. Then it is 20 and 20. So I think it's 154.
Yes, sir, 154.
That's right. Then there is a bill receivable, but there is some intercompany owings on the bill receivable, not in the additional information, but if you notice within the balance sheet, on the liability side, bills payable, some intercompany owings are given. So we'll take care of that. So bill receivable is 36, 0 and 15. And if you look at the bills payable side, I think the bills payable between Usha Sandhya is 35 and 15. It's 50. So that will be eliminated. That I think leaves us to bills payable 1.
1.
Correct. Then there is a trade receivable. I think there is no intercompany owings. So trade receivable is 130, 50, and 110. No adjustments.
290.
290. And then there is inventories. There is a stock reserves to be taken for inventories. In whose balance sheet, though it's, I think, taken an adjustment, so not a problem. So we are given inventories is 110, 35, and it's 25. And stock reserve, I think, was 1, if I rightly remember.
Yes, sir, 1 lakh only. 169.
Correct. So 110, 35, 25, and 1. This is 169.
Yes, sir.
Right. I think that's it on the asset side, I guess. So that takes care of the asset side of the balance sheet. $1104, I guess. Right. Is that the total? I think 1104. Let's now go to the liabilities side of the balance sheet as well. So extend the format. So this is easy to track your mistakes as well. So I think this is better. So we've got Usha, Nisha, Sandhya, adjustments and the total. So let's take the equity and liability side now. So we've got, first of all, the equity section, that is equity share capital. I guess we can directly take the parent, that is 300. If you want, you can show the adjustments. Then there is other equity. So what was the other equity in step number 6?
280.90.
280.95.
990, I think.
Okay, 280.9. Okay. So this is 280.9. And I think least we forget, let's take the NCI. So NCI would be 83.1. Both the companies put together. And that's it on the equity side. There are no non-current liabilities. So now we are given the current liabilities in the question. And on the current liabilities, we are given there is a trades payable. I think there is no intercompany owings on the trades payable. That was bills payable. So 235, 115, and 90. No adjustments. 440. And then there is a bills payable. So bills payable will get cancelled because there is no outside bills payable. So that becomes 0. All the intercompany owings are cancelled. So this is appearing at 15 and 35. So this is 15, this is 35, and this is minus 50. So I guess hopefully the balance sheet should get tallied. So 300, 280.9, 83.1, 1104, I think was the total. Yes. Wow. So this, I think, tallies the balance sheet as well. So my chain holding consolidation is also done. There is one similar kind of question, which is also been there in the exam. Absolutely quite similar style. So maybe you can try that out on your own, a similar kind of question. So I think consolidated balance sheet is fully done, except that, I am a little apprehensive of doing that kind of a comprehensive question in the next class. I don't know. I'm a little apprehensive. The responses on these kind of questions gets me scared. You want me to do that kind of comprehensive question in the next class?
Yeah, please do, sir. We will gear up.
Okay, wonderful. Then I think we'll do that. So next class, my focus will be practicing on the balance sheet and on the consolidated P&L. I'm planning to do a question on a consolidated balance sheet, which contains a lot of adjustments, including deferred tax and all, and a comprehensive question on the consolidated income statement as well. Maybe we can add a flavor in terms of that balance sheet as well as the question which is on the income statement, including a subsidiary and an associate both. Because associate is also part of the consolidation, so maybe I can land up doing a question which is balance sheet, subsidiary associate, as well as a P&L subsidiary associate. I think that would be a good treat to watch in. Anyway, I think that brings us to the end of the inputs today. So I think we're done on this part. Over to you for any questions at your side.
No, sir. I will do the community revision, all these things.
Okay, wonderful indeed. Right, friends. So I think that it's time to bid you goodbye on that. So I'm going to see you on Sunday, and we're going to do some interesting questions on Sunday. Thank you very much. Bye-bye, and take care.
Thank you, sir. Have a wonderful day.
Same to you. Thank you very much. Haji, thank you. Same to